Hello everyone, good morning to our lecture series in derivatives. Today we are honored to have Salomon Sebbag here. He is a very experienced, still very young but very experienced individual.
Thank you.
He was with JP Morgan for how many years?
26.
26 years with JP Morgan. I've never seen anyone who stayed so long with one institution in financial market. So he's very unique, but it's not just unique that he stayed for 26 years with JP Morgan. He had a very interesting career over there in derivatives, and he's going to talk about that. So he prepared the presentation. He's going to talk about a little bit about that, and then you have the opportunity to ask questions and be a little bit more interactive. So over to you, Salomon. Thank you very much.
Thank you, Jacob. I have an hour roughly, right?
Yeah, all together.
Feel free to cut me off.
Yeah, you can speak for an hour, exactly. You can
Okay.
speak for 20-30 minutes, and then we see, then they ask questions.
Excellent, excellent. Good afternoon, good morning, should I say. So I am not an academic. I don't have a PhD. I am
Not yet.
I am much lower level, much less smart. But I am what you could call a financial market professional. So I've spent my entire career in what you call the sell side in banks, as Jacob said. So very quickly, I'm a former managing director at JP Morgan. I spent 26 years managing trading books, mostly in interest rate space, and teams of traders, mostly trading interest rate, but not only. My areas of expertise, obviously, interest rate derivatives, IRD. Emerging markets, I've spent a good chunk of my career looking at countries like Turkey, South Africa, Russia even, very interesting one. I went through a number of financial crises. The big one, you probably heard about it, is the 2008 crisis, the great financial crisis, subprime crisis, multiple names about it. I've traded FX as well. I was last working for Morgan Stanley until the middle of last year in the emerging market rates division. I can send you later on my presentation if you want to forward it, and you can follow me on LinkedIn. I post usually about financial markets and interest rate space. Okay, so this presentation, let's be fair, is a summary of the module I teach at Cambridge and at ESCP, the French Business School. I usually spend around 18 hours, so it's going to be a bit of a challenge. I'm trying to compress that really and focus on the real interesting things. So first of all, why should you be interested as students and just as persons in interest rate derivatives? First of all, interest rate is really the backbone of financial markets, right? You can't really be involved in financial markets without understanding what's happening in interest rate. The present value of any cash flow, no matter if you value a company or just financial products, you need to understand what is happening in the yield curve and how to discount that cash flow. Interest rate derivatives have exploded really in the last 40 years. They really started in 1981. The first real swap was made between IBM and the World Bank. And since then, the volumes, the interest, the business has literally exploded exponentially. Interest rate derivatives have made it easier to invest, to hedge against fluctuation, and also to understand interest rate forecasts. You can now look at any interest rate swap curve in the world and understand what the market is expecting in the future. So no matter where you end up in finance, or even generally speaking, you need to understand interest rate. If you end up having a mortgage one day, you're going to be involved in interest rate, and you need to understand what's happening there. So a few headlines just to tease your interest. Goldman Sachs research has pushed back bet on first Fed interest rate cut to June. So right now we live in a world where people are talking about rate cuts. For the last couple of years, the real world was about fighting inflation. And when you fight inflation, central banks have to hike interest rate to slow down the economy and prevent prices from going up too quickly. But back in November, October last year, the inflation data has started to top up. You probably have noticed yourself, prices have gone up for the last couple of years, but now they're starting to slow down, and people have started to price rate cuts in the US, in the Eurozone, in England as well, pretty much across the board. In some emerging markets, actually, rate cuts have already started to be delivered. So this is really the debate at the moment about when rate cuts are going to start. Okay, and just to make it a bit more metaphorical, central banks have the mandate to fight inflation. Typically, most central banks have a corridor they try to target between 1% and 3%, and they use the tools they have in their toolbox, and mostly monetary policy, interest rate, to try to achieve that. Now, inflation is on a downward path. We don't know how quickly this is going to happen, but this leaves room for the Fed, for example, to cut rates. Obviously, targeting inflation is a very challenging job, and it's sometimes you overshoot, which has been happening for the last 2 years. Inflation has gone much higher than 3%, but also the danger is if you go into recession space, then prices can actually come down aggressively, and you can undershoot your target. Hence the caution. When you talk about interest rate, really you talk about the front end, the monetary policy, which is what the central bank in that particular country is targeting. So here you've got a list of a number of major economies, and they're classified by the level of interest rate. So typically, Japan has always been a low yielder. It's probably the only country in the world which still has negative interest rate. Even Switzerland has high rate, and the big one are the euro, obviously 4.5% benchmark. United Kingdom 5.25%, and the United States 5.25%, 5.5%. So these rates in the US, for example, which is obviously the major market we follow, were pretty much at 0% 2 years ago. So we went from 0 to 5.5 in a pretty quick pace. By the way, this isn't meant to be interactive. If you want to raise your hand and ask question, don't hesitate. If you go if you go down the ladder up in rates, you start touching emerging markets economy typically. Why? Because emerging market economy are more volatile, both inflation and GDP growth, and also their currency end up being more volatile. And in order to stabilize and give a bit of anchor to those economy, interest rates have to be higher, which means investors need to be incentivized to invest their money in those economies. So you're looking, for example, Brazil, 11.25%, Brazil, Mexico, more volatile economy. South Africa is one of the big EM markets as well. Russia is a bit outside of the planet at the moment for sanction reasons, but it used to be also a very big market before the war started. And just for the record, the two big high yielders in EM space, Turkey, 45% interest rate, and finally Argentina. Long-term rates, on the other hand, is where investors can earn a yield for long-term, and conversely, if you need to borrow money, where can you borrow? So these benchmarks, the US 10-year particularly, is really a very important benchmark. Any investor or financial market professional look at these rates every single day, basically, particularly the 10 years. So the 10 years around 4.25. At the peak last year, it was just about 5%. If you look at 2 years ago when rates were at 0, this was 1.5%. This is basically the benchmark for an investor who is going to decide, am I going to invest in this product or not? It will always benchmark that return compared to the 10-year. Example, if you come up with a financial product which earn 8% in the US, it compares pretty well to this benchmark because you're earning more than the US government bond, which is meant to be the safest credit or among the safest in the world. And anything above that will be considered potentially an interesting investment, especially if you look at the risk involved. So anything riskier will have to earn a higher yield. And if you come up conversely to an investor right now and tell them, okay, I have an investment which is going to yield you 2.5% for 10 years, the investor is going to say, well, this is useless because I can earn 4.25% in 10-year US Treasuries, and that's pretty much risk-free. These are the benchmark in Europe. Germany is meant to be the gold standard in Europe in terms of bond yields, and then you have higher spread like Italy, Spain, meant to be more risky. UK has had an interesting story. Probably, if you have followed the last couple of years, particularly in September 22, we had a bond market crisis following a budget which was very lax, let's say, or unfriendly and the 10-year shot up 1.5% in a couple of days before the Prime Minister basically had to resign a couple of weeks later. So there's this slide, basically short-term rates, monetary policy, and long-term rates is where investors are going to price the confidence they have in that particular market, confidence to repay debt, obviously, and confidence that the inflation is going to stand under control. And again, this benchmark will be seen as a reference compared to other investments. Yeah, question?
Yes, could you please elaborate more on the Japanese negative interest rate? Just
So,
to understand.
Japanese economy has structurally had a really big problem with deflation, for many decades. Huge saving rate, aging population, a lot of cash in the saving system, and the problem there, the risk really, because people are always worried about hyperinflation and high inflation, which is something we know in Europe, obviously we've seen in the last couple of years. But there, for many decades, the problem was deflation. Deflation is also very bad because prices go down, the economy slows down, people don't want to buy. If you know something is going to be cheaper in 6 months than today, you're not going to buy it, okay? So you can really destroy an economy like that. So the Bank of Japan has been erring on the side of caution, but on the other side, and has been really resisting this rate hiking cycle we had pretty much everywhere. And the consequence, though, is that the currency, the Japanese yen, has depreciated a lot on the back of that. Because as an investor, you're like, well, I can earn 5% risk-free on the US. Why should I invest in Japan? So dollar yen went up a lot last year. You probably saw that if you follow the market. It went up around 15-20%. And today, people are talking about rate cuts, but Japan has still not moved. So in a way, they're just sitting there and hopefully, they have, I think now it's clear they have avoided deflation, and you probably saw also the Nikkei has made a new high, 34 years after the last high. So the economy was kind of recovering for the best part of 30 years, and it is possible at some point the market will start pricing some normalization of rates, because the negative rate is something rather unnatural, exceptional. It happened obviously in the Eurozone just a couple of years ago, you had negative rates. And it happened also in Switzerland, because Switzerland obviously attracts a lot of money when there is risk aversion and people are worried about the world economy. So that kind of pushes. Yeah. Okay. Any other question? No. Okay. So this is, for example, this is a 10-year US yield benchmark. As I said, this is really important, an important benchmark. So, this was the COVID time when rates were rallying across the world because central banks had to cut to help the economy. The economy crashed pretty much. You had basically in March 2020 a sudden stop in global economy. And the central banks cut rates. Also, they were doing QE, which means they were buying bonds to push yields lower to help. And since then, obviously, the economies have sort of recovered. And suddenly, we realized in our major economies that we had an inflation problem. Inflation shot up. Okay, because there was not enough supply, and the demand started to grow, and then central banks started to hike rates, but the bond market was really worried about inflation going to 7, 8, 9% even in some areas, and this is what happened. And more recently, this rally here, which is quite big, so it's almost from 5% to 380. This is where basically the market has realized the inflation problem was starting to be under control, and on the other hand, the inflation was going to come down, and the market thought, okay, that's it. This is an inflection point, and you start pricing rate cut. So, more specifically about interest rate derivative, and that's what's interesting about interest rate derivatives. So, this might look a bit esoteric, but basically, the derivative market can help you read what is priced in the future for interest rate. Okay. So the way you read that, every 3 months you have a contract, a future contract, which is traded in price. So the price means the implied interest rate is 100 minus the price. So here, for example, this price is 96.02, which means you pretty much price 4% interest rate. This is the June 2025 contract, which means slightly more than a year from now. And you see the US curve basically has been pricing higher prices, which mean lower yields. The curve is heavily inverted at the moment, because there is an expectation that the Federal Reserve is going to be cutting rates. So why am I showing you this? Is because, you know, even if you don't trade interest rate, it's really interesting because the market is going to tell you where rates are priced in the future. The market may not be right, but it is what is expected. And, you know, investor will make decision based on these implied rates. Yes?
But obviously this is not a guarantee. I mean, it's very likely that interest rates will go down, but it's not guaranteed, right?
Absolutely. And this is where, you know, there's a whole bunch of investors who are looking at this every day, and they talk to their economists, strategists, they have models to predict inflation, and they look to see if there are any discrepancy. And as soon as you see a discrepancy, guess what? There is an investing opportunity, there is a trade there. So some people at the beginning of this year were thinking, wow, there's like 5, 6, even 7 rate cuts priced in the US curve. The curve was very, very inverted. Suddenly the market was completely euphoric about that. And a number of investors, you know, has decided that this was too much, and they put bets against that. So typically selling futures or buying FRAs, you know, that's how you bet. And you may have seen the headlines, one of the big hedge funds out there called Rocos has made $1 billion in the last few weeks on the back of that bet, because when the curve was pricing 7 rate cuts, now we're more like 3 rate cuts. So all these prices have gone down a lot. So you're right, there are opportunities, markets are not efficient in that way. And if your model, if your economist, if your strategist is smart enough and can anticipate things, then there are opportunities to make a lot of money. Don't forget also that structurally, and I digress a lot, you obviously have what you call macro investor. Macro investor will look at inflation, GDP, and rationally with an economist are going to decide where inflation is going and where GDP grows. You also have a whole bunch of the industry today, in the hedge fund industry particularly, who is based on algorithmic model. So in a nutshell, without going into details, an algorithmic model is going to invest money based on statistical model. A very simple example, trend following. Trend following is simply if you see a trend developing over the last 3 to 4 months, for example, or 6 months, well, the model is going to tell you there is a trend forming here, this trend is going to last for 2 years maybe, and they keep adding to that trade. So it has nothing to do with the macro fundamental picture, it has to do with statistical algorithms who are going to basically give orders to investors to buy this market because it's trending higher or lower. There's also mean reverting models. There's a whole bunch of industry, and you would be shocked to see how many billions of dollars are invested in those models. Because typically those models are very agnostic in terms of what's happening in the underlying economy, and they are based on long-term statistical data, and apparently they work pretty well. So why am I saying this? It's because sometimes you have a rally pricing rate lower, which is what's happening in November, December, and this is the chart by the way. So when you have a trend like this is one of the contrasts basically, suddenly a lot of algorithmic model, which have nothing to do with the economy, will say, okay, there is a trend forming here, it's going down, so let's just sell here aggressively. Or conversely here, you had a very nice one for almost 3 months. And that money will pour every day and will push prices, and sometimes push prices into exaggerated territory. Okay? And this is where, on the back of your question, this is where the macro people will see, okay, this is overshooting what the fundamental value should be, and there is an opportunity. So, why are derivatives so popular? How are they used? How banks make money? How do you manage risk? Can they be blamed for crisis? Do they increase prices and leverage in the system? We're going to try to answer this very quickly in the time I have left. So, first of all, what are interest rate derivatives? In the investing world, okay, you have 2 types of player. You have cash player, example, if you are a pension fund, you have money under management, okay? When you invest your money, you're going to buy bonds, equities, sometimes some private investments, etc. But these are cash investment, which means you are going to send literally money from your treasury account to buy those bonds and equities. Okay? Against that, the derivatives industry has exploded on the back of the fact that a derivative product is a product which pay out is based on an underlying asset. But typically you don't have to send the cash. Okay? Example, those futures I showed you, typically, you only exchange the difference between the price you buy and the price you sell every day, pretty much. So this is what you call mark to market. So you could be literally bet on a notion of $100 million, having only in your bank account $10 million, okay? So you can leverage your position, you don't have to outlay your money every time, and that made the derivatives market extremely liquid. And in fact today, whether it's in interest rate space, but also in a lot of other derivatives market, the derivatives markets are a lot more liquid than the cash market. For example, in the bond space, you know, when there's a big number in inflation, the futures market will move a lot faster than the underlying cash bond market. The cash bond market will be like the equivalent of a super tanker, and the derivatives market will be like a high-speed boat, okay? Because it's liquid and it trades in a good volume. You also have two types of interest rate derivatives. You have the linear product. So typically, the payout is going to be a function of interest rate move, and it's going to be linear. And you have non-linear product when you start involving optionality. So optionality, as you may have learned, an option gives you potentially an unlimited payout when you buy it, and conversely, an unlimited downside when you sell it. So very simple example of derivatives, a forward rate agreement, which is simply putting a level in the future of, say, a 3-month rate. And if you think that level is going to be higher, like we said, you know, you buy the FRA and you will have as a payout the difference between the price you bought and the settlement. Okay, that's a FRA. Futures work in the same way, except they trade in price. You also have a category called foreign exchange swap for derivatives, where you can borrow in one currency and lend in another one. That's also a derivatives product. But the most famous of all is, probably you've heard, the swaps, interest rate swap, where you basically exchange a fixed rate, a stream of fixed rate cash flow versus a stream of floating rate cash flow. What this really does is basically you're speculating on future interest rate movement. In other words, if you think interest rates are going up, you have interest to pay a fixed rate of cash flow and receive a floating one, because the floating leg will start being very valuable, and conversely. So these swaps market are the backbone really of derivatives, and they now exist pretty much in every market, including emerging markets. You also have the nonlinear, as I mentioned, swaptions, cap flow, which are going to protect you in case of big move up or down, and finally structural note, which basically is like having a bond whose payout is going to be based on pretty much anything you want. The formula can be leveraged, it could be a max of a level different of a benchmark minus a certain level, etc. The sky is basically the limit. So how are interest rate derivatives traded? So historically, you know, you basically had two players, you know, two banks or one client and a bank, basically decide, okay, we are going to go into this derivatives trade, this swap, for example. I mentioned IBM versus the World Bank. So these involve two institutions. They trade together, they exchange their cash flow, and no one knows about this. As the history progressed, there were issues with this sort of model, particularly in 2008 crisis, where you realize that you have a credit risk. If you enter derivatives and the counterparty owes you a lot of money, then you have a problem if that counterparty goes bankrupt, right? You may have heard the story that, you know, Goldman has bought CDS on Lehman Brothers from AIG back in 2008. So they were very happy because they had protection. Lehman went bust, they were protected, except that AIG was bankrupt effectively, so they couldn't pay, which is why the Treasury had to bail them out. So basically, post-08, there was this model where all the derivatives, or most of them, had to be traded through a clearing house, typically LCH or CME. What does this mean? JP Morgan trade with Goldman Sachs, for example. Instead of facing each other, they are going to face an exchange in the middle, who basically are going to call the two banks every single day and tell them the trade you have versus the other is either in the money or out of the money, which means you owe money or you are owed money, and they are going to exchange their daily P&L every single day. What this does, obviously, is that if there is a big move or a crisis, we don't really care, because your mark to market, your P&L as of last night is already in your treasury desk. So you're not owed a lot of money at any point in time. The only risk, obviously, is that if you have an overnight movement, which is not covered by what you call the initial margin, which is an extreme case, but it can still happen. So who are the users of interest rate derivatives? So I mentioned bond investor. Imagine you are a bond investor, you manage money for your clients. Typically, you are going to be long duration by definition because you are going to be long bonds. What happens if you expect rates to go higher, like 2 years ago? Everybody was starting to be nervous by inflation. You have two solutions. Either you sell your bond, you reduce your duration, which would be the natural thing to do. But remember what I said, if you have a bond portfolio and say you have, I don't know, $50 billion under management, it's not easy to sell that portfolio because some of the bonds can be liquid, some can be off the run. It can be quite a problem. What you can do against that is you can simply go in the swaps market and pay fixed. As we said, if you pay fixed, you are going to receive float. So when the float goes up, you are going to compensate for the losses you are going to incur in your bond portfolio. Okay? So a bond investor can hedge and reduce their duration on a portfolio. And the beauty, as I said, is the derivatives market is more liquid than the cash bond market. So you can do that for, say, you can hedge a third of your portfolio, and that's going to protect you through that movement. If you are more bold, you can hedge all of your portfolio if you wanted to. And then when the movement is over, say last year, and you think rates have topped up, then you unwind that swap. And that's also something which is very easy. Banks are providing prices on a daily basis. There are dozens of banks who are pricing these derivatives now, and you can get in and get out pretty easily. The other example is the corporate hedger. You have a big project, you need to finance it, but you worry that rates might go up. Rates today are at 4%, what if they go to 7%? Your project might end up being underwater, and that's going to put the whole project into jeopardy. So what you do is you go in swap and you can lock in a long-term rate, say a 10-year rate, to make sure that your financing is locked in, and you can sleep well at night, no need to worry about that. So in both first two examples, I mentioned people worried about higher rates. Now, if you jump to the third example, so the fourth example, investor. So investor is the other side of the equation. You are cash rich, say you are a pension fund. What you're worried really is rates coming down too much, because what you really need to deliver to your future pensioners is a steady return, hopefully a positive real yield. So when yields are very low, it's really a problem for you. So sometimes the swap market or the derivative market can provide opportunity to enhance the yield you're earning on bonds. Because swaps can trade sometimes above bond yield. One of my favorite trade in my career was to receive Turkish swap back in 2008, after the crisis. I was receiving swaps almost like 600 basis points above the equivalent bond yields. Okay, so that's an interesting trade as well, where you can enhance the yield. The last example I wanted to say on the back also of your question at the back is the fact that all these curves are pricing future interest rate policy. And you have a whole industry of people, mostly in hedge funds, who are basically going to speculate against those levels if they disagree, obviously, with them. And people are spending days and hours doing research, looking at the data, and analyzing also central bank policy, what is going to be the reaction function. You can be sure, like for example, this year there's a lot of people combing through the US data and trying to understand exactly when the Federal Reserve is going to cut. And in this industry, every basis point is going to be important. So there are literally billions and billions of dollars being invested in those macro strategies, and they are a heavy user of interest rate derivatives product. So on the other side, so we've seen the client side, who makes the prices on the other side? So the client side is what you call the buy side. The sell side is the bank side. I have spent my career on the sell side. So who is going to make the price and how do you make that? So banks are set up in this way. An investment bank is separated between the public side and the private side. The public side is the financial market side. And banks have market-making desks. So literally, you have traders whose job is to show prices to clients at any point in time. And the way they show prices, they are going to show what you call a two-way price. You are going to show a price when you buy the product, and you show a price when you sell the product. And this is aimed to provide full transparency to the clients. So you're not going to read the client. If you know the client is a buyer, you are going to show high price. No, you can't do that. You have to show something which is going to show the two ways. So a market maker is going to have access to brokers. So brokers are institutions who speak to a lot of banks. So you could have a buyer, a seller, and they try to match these people. Banks have access to exchanges, so they can use futures. We mentioned futures are pretty liquid as well in the interest rate space. And obviously they have access to clients. So when you have a client who wants to, for example, pay in swaps because he wants to hedge his interest rate exposure, maybe an investor wants to receive at the same time, and they are going to try to match that. So the market maker basically is going to match buyers and sellers, and in the process, hopefully, capture what we call the spread between those two rates and hopefully make money. So banks profit from market making. This is the bread and butter activity, but also positioning. Most banks, at least the banks I know on the American bank typically, have a pretty serious risk appetite, which means that a trader, I give you an example. 2 years ago when I was trading, rates at Morgan Stanley, it was clear that inflation was a problem, that central banks were going to hike. So, we positioned our books ourselves to be paid in rates because we knew the rates were going to go up. And whenever a client was coming and paying rates, well, we simply would go pay and hedge that trade, and we would keep a core position paid rates, which obviously worked pretty well. And on top of the market making profit that we made, we also had positioning profit. So that makes market making activity a very interesting one, but also a very risky one, because when you get it wrong, you can also lose a lot of money. And it's completely the opposite of what a broker or someone who execute, you have a high net worth client who calls his private banker and say, okay, I want to buy, Amazon shares. The banker is simply going to execute. He's not going to take any risk. When you are a market maker, you basically say, I'm going to make you a price on, $1 billion worth of Amazon shares, and the market maker is holding to that risk and managing that risk in order to hopefully make money. If he thinks he can find a seller at a reasonable price, he would run that risk for a few hours, sometimes a few days, and sometimes even longer. So risk complexity. So interest rate derivatives can be a bit mysterious, but at the end of the day, when you split the risk into components, it's not that hard. When you trade a single stock or FX, obviously your risk is monodimensional. So you buy a currency goes up, you make money, currency goes down, you lose money. Simple. In interest rate space, you are basically playing a multi-dimensional game. Multi-dimensional because obviously you are exposed to interest rate going up and down, but you also have the curve moving because you are exposed from 0 to 20 years, 30 years sometimes in some markets. In emerging markets, usually 10 years. So the curve can, what you say, steepen or flatten, so that gives you an extra dimension of risk. And also what I call the basis. When you trade interest rate, you trade a number of different products which are going to generate exposure. You can trade bonds, and against those bonds you can have swaps. You can have FX swaps, you can have futures. And these products can move together, and they are very correlated obviously, but sometimes they have divergence movement, and you need to monitor those movements. So that gives you a third dimension into your risk management. So typically one classic move would be to buy bonds and pay swaps against it, and play what we call the asset swap, which is a spread between bonds and swaps. I mentioned it earlier in Turkey. This was something which was very interesting back in the days. So what drives swaps rates or bond yields in general? Okay, so we mentioned monetary policy anticipation. As I said, you have hundreds of people who are watching central banks' rhetoric and are trying to understand the reaction function of a central bank. What makes them hike rates or cut rates? Which data specifically, which number? Okay, so that's going to move particularly the front end of the curve. The term premium is probably more the longer run. Term premium is typically, if I told you you're going to lend money to someone for 10 years, typically you would want to lend at a higher rate than if you lend it for 3 months, because your money is at risk for longer. This is what you have bond yield term premium in the long run. In particular in emerging markets, it's pretty clear that you take South African government bond yields, if you look at the long run, 10, 20 years, they're very high because who knows what will happen in that time frame. And the last but not least, like in any market, you have supply and demand. Who is going to pay swap versus receiving? We said corporate hedger versus investor. In the bond space, it's the same. Who is going to buy bond versus who is going to sell? So typically, cash risk investors have to buy bond by definition. But against that, who is going to sell a lot of bonds? Government. And we know that government deficit, particularly in G10 world, have to issue a lot of bonds post-COVID, etc. The deficit have exploded. So there is a lot of supply of bonds, okay? By the way, I don't know if you guys have a private pension, or you will have private pension, right? Don't rely on public pension system to pay for your retirement. Huh? Make sure you have something on the side. Because by the time you guys retire, a long time from now, but 30, 40 years from now, public pension system might all be bankrupt because they will not have enough money to pay. What has changed over the last decades? So, technology, just taking, I'm reading time. Technology, regulation, and a lot of consolidation. So, let me give you a quiz on this picture. Who can remember? Jacob, you cannot play. Huh? Who knows what this is?
Jacob?
Yes, very good. Great culture. That was in 1987. The movie is called Wall Street. If you haven't seen it, please do. It's a really interesting one. Pretty seminal in terms of the culture. The reason I like putting this picture is because obviously everybody can notice the lovely mobile phone he's holding. But guess what? In 1987, it was so cool. The guy was a billionaire in the movie and he had this mobile phone. No one had mobile phone at the time, so it felt like state-of-the-art technology. Obviously today it looks absolutely horrendous, and anyone who would turn up with a phone like this would be laughed at, right? So this is just to show you how much technology has completely revolutionized trading and financial markets and investing, So one example is the explosion of e-commerce and e-trading. Back in the days when I started my job, it was in the 90s, 92, 93. Literally, if you had to do a transaction, the client would pick up the phone, call a bank, ask a price to his favorite salesperson. The salesperson would call the market maker, who would be on the other side of the room, and say, can you make me a price? He would make a price, it would take him a couple of minutes or whatever. And then the price goes back to the client, says, okay, mine, yours. Then literally the seller would take a paper ticket and literally write down. Then timestamp it, send it to the mid office or back office. Someone would literally key it in the system. I mean, the whole process was like ridiculously long, error prone, etc. It was beyond imaginable. And you can imagine that processing a ticket like this would have been extremely expensive. Today, obviously, most clients we talk to, only they want is click on a screen and trade, basically, like probably all of you guys. They don't want to talk to anyone. So particularly in very plain vanilla product, in derivatives, also in a lot of different markets, like in FX, I'm told that 80% of the FX volume, foreign exchange volume, every day is going through electronic system. Because basically people won't be able to click. And when you click, you trade, the ticket is automatically generated. It's straight through processing, STP, it goes to your system, it goes to the counterparty system, the back office is matching confirmation, and the payment will go automatically 2 days later. You don't even have to worry about, and the whole ticket cost is a fraction, maybe 100 times cheaper than it used to be 30 years ago. So that's one of the aspects of technology. Regulation has, there's a lot more, but obviously for interest of time, I'm just keeping. Regulation has dramatically changed over the last 30 years, particularly because of the 08 crisis. The 08 crisis, in case you're not aware, we basically saw the financial system close to breaking down. You had literally banks on like big banks here in this country. A bank like NatWest, Royal Bank of Scotland, was literally on the verge of being bankrupt, and they got bailed out by the UK Treasury. But that was true also in the US with obviously Lehman, etc. So a number of institutions were in trouble, and the Treasury had to bail them out. So after the 08 crisis, the spirit of the regulation was the following: that taxpayers should not have to bail out private entity or people who take reckless risk. And that's why the regulation has increased heavily. You have a whole bunch of regulation you may have heard in financial markets. Dodd-Frank is one of them. The Volcker rule is to prevent banks from taking proprietary positioning, which is a very nice word for speculation. Before 08, that includes also JP Morgan, we used to have like literally prop desks with dozens of traders who were speculating on any markets. And when you speculate, obviously you commit the capital of the bank, and when things go wrong, the bank is on the hook, and the worst that can happen to a trader is to lose his job, nothing else. So all this regulation has forced banks to stop prop trading, to put a lot more capital set aside against any trading operation to absorb any losses. You have also, a number of rules and regulation like desk manager are liable for their entire team if something goes wrong. There are bonus clawbacks, so the banks can get the bonus to be repaid if there's something wrong the following years, etc. So a number of things like that. So I mentioned bonus caps, clawbacks, and surveillance as well. If you end up working in a bank, be extremely careful because anything you type on a chat or email or what you say on the phone, everything is saved. And it's not saved for 2 weeks or 1 year. It's saved forever. I have seen people being pulled in compliance rooms for investigation because of something they did or said 10 years before on a chat to a client, and they say, what did you mean when you said that? Did you intend to mislead a client? And by the way, it may sound obvious to you guys, and it was obvious to me, lying to a client is not acceptable, and it's usually a big problem. There's a guy in one of the bond houses in the US who basically ended up in jail because he sold a bond to a client, and he said, okay, I can sell you this bond at 120, and he said, I got this bond really cheap for you, but I can say it at 120, I bought it at 119, so he took 1%. And that was a lie because he bought it much cheaper, and because he lied, he ended up in a tribunal and ended up in jail, because basically you cannot mislead a client, you cannot lie, so this is part also of this new effort of regulate the market. No matter what you do in a professional setting, you have to be accurate, professional, and not mislead client. Don't play with those rules because today all the banks are extremely on top of all these things. Market consolidation. So when I started in this industry, you had literally dozens of banks trading a lot of different markets. But like in any other industry, it felt over the years that in order to be profitable, particularly in the market-making business, it's true in derivatives in many other markets, you really need to have a significant market share in order to leverage that to be profitable. In other words, when you have, say, 20% market share in a market, you can see enough flows and information in order for you to have a good picture of where the market is going. An example, if you come in the morning and all the clients are calling you to buy the market, where you feel there's something going on, there's maybe a news or there's a big flow or there's a theme. So it helps you trade also your book and position correctly. If you have 1% market share and suddenly you have a client who buys from you and then the market goes much higher, you have no idea. So in order to be profitable, you need to have a decent market share, being in maybe the top 5 player, or top 3. And this is also why a lot of banks have disappeared in many markets because they were simply too small. Like I said, I worked for JP Morgan. JP Morgan has been the result of a number of mergers. When I joined back in '92, it was a 15,000 people institution. It was a rather small investment bank boutique. And today, JP Morgan has a $500 billion market cap. At the time, it was maybe 10. And has 350,000 people. So a lot of merger have occurred, Chase, Chemical, Bank One, you name it, Burstone, all these banks have merged into this one entity called JP Morgan, which effectively is the result of all that. And again, market share is very key in a lot of businesses, and particularly true in trading. Conclusion. Interest rate derivatives are at the heart of today's financial markets. Like I said, interest rates really are going to define a lot of other asset pricing. If you trade equities, etc., if interest rates are going to shoot up, that's going to have an impact. And conversely, in November you probably saw when the bond market started to rally aggressively, suddenly the S&P 500 rallied 9% in a single month. And in fact, we were up 20% the last 4 months. So the trigger for the rally in the S&P in November was clearly the fact that inflation was stopping, and also that interest rate, particularly US 10 years on the front end, started to rally and price rate cut. Rate cuts effectively, are going to push prices of assets higher, and this is exactly what happened. Trading and investing is a very exciting job. It's a high reward job and a high risk as well. But what I can tell you, having been a professional for 30 years, every single day is different. You cannot predict everything. In fact, predicting is almost impossible, and you have to be pragmatic. The good traders, the good investors are the ones who have scenarios where they make a lot of money when they are right, and they lose not too much when they are wrong. Because I don't know any single investor who is always right. It's impossible. If someone is right 60, 70% of the time, that's already an extremely amazing ratio. And at the same time, trading and investing is a very humbling experience because, as I said, there are many things which are out of your control and you can't predict some of these things. I'm going to leave you with this final quote. Predictions are very difficult, especially if it's about the future. It's from Niels Bohr, a physicist. Thank you very much for your attention, and I'll take any questions if you have any.
Thank you so much. It was fascinating little tour d'horizon of your career and of the interest rate derivatives market. I think we have 10 minutes left. Any questions?
You can choose either questions or I have a quiz.
You have a quiz. So perhaps Andre and then Angels. Andre, yes?
Considering the significant technological development that we've seen in recent years, do you believe the market could become 100% efficient and we might lose such intermediary as investment bank? And if yes, what's your prediction?
So your question is about market efficiency, right?
Yeah.
So it's interesting because I'm sure you've read about efficient market theory, etc. And theoretically, it's a very interesting concept. I think the efficiency I have seen personally in core markets like the US, Euro, etc. These are a lot more efficient than, say, emerging market. If you look at emerging markets, which are less liquid historically, etc., there is definitely a lot of value. For example, I was trading Turkey for 10 years at JP Morgan. We used to have we had an office in Istanbul, and we had a local economies, we had local connection. So the value of having extra information is very, very important and can be translated in an edge, and you can profit from that. Because if a news comes in the local press in Turkish, not everyone has it already, etc. So you can go faster and be more efficient if you have the right connection with the Ministry of Finance, the central bank, etc. You can also have access to more information, more color. So the simple answer is markets are not efficient. As a practitioner, I can tell you that, but they can react a lot faster in some markets than other on the back of coverage. It's obvious that today the US market is one of the most liquid in the world. It's probably the closest you can find to an efficient market. But if you trade Brazil, Mexico, or Turkey, there's still a lot of value of having access to information locally and having good research.
So you're saying that the possibility of market to become 100% efficient is unlikely?
Yeah, I don't think market can be 100% efficient. There's always mispricing, there's always news that you can, or analysis or homework or research you can access. Even in the Eurozone and US, which are the most efficient, one of my friends, which I talked last week, who is a former portfolio manager at Blue Crest, was telling me that if you read all the research and the research is like miles ahead of what you see in the public domain in the press, for example. So investors typically have an edge, and the question is which investor is going to be the first one to notice, say, a change in inflation or GDP, etc. And so there is definitely a possibility to actually profit from that, but it's harder in a liquid market like the US and Europe.
Angel?
I actually have a few questions. So the first one is, so you've been JP Morgan for 26 years as a trader, and you probably started off as an analyst. What were the things that you did that gave you the opportunity to go up in ranks, to take more responsibility as a trader, bigger portfolio, essentially become a manager as you were. What were the things that you were doing to strive like that?
Very good question. So, first of all, you have to enjoy what you're doing, and you have to perform. The reason why JP Morgan historically has been so good is because it's very much a meritocratic institution, which means people who perform have a chance to go up the ladder and have more responsibility, etc. So the key word there is meritocracy and performance. So, and to perform, you need to enjoy what you do, and work hard. Be smart, work hard, and have a bit of luck, obviously, being in the right place. One of the luckiest decisions I had or opportunity was that at some point I was working in JP Morgan Paris. There was an opportunity in JP Morgan Madrid because they had a staff shortage, and I was sent for a year to manage the books there, the interest rate derivatives books. I was pretty junior. I was only three years into my job, but basically because I went there and I was visible very quickly because I was living and dying by what I was doing. Basically, if I had failed, they would have said, "Oh, it's my fault." But because I did well, they said, "Okay, because Salomon did well," etc. So you have to take a bit of risk, try to be visible, and my real advice to anyone starting a career in anywhere is make sure you pick up something which you're passionate about, which you enjoy. Because when you enjoy something, you don't look at the hours, just work hard and you enjoy it. And that's really my advice. Work hard and enjoy it.
And last question, what's your favorite trade of all time?
My favorite trade of all time, okay.
You mentioned it, the Turkey trade.
2008. It's the asset swap trade so what happened in 2008 was this big crisis, and investors were what you call risk averse. Stock markets were collapsing. Any trade they had, any high yield trade in emerging market was like, I don't want to hear about this. And you really had like massive opportunities in asset swap. In other words, this is where people are in distress and they sell any asset at any price. So early January 2009, we felt that things were settling down. The confidence was slowly coming back, and you could literally pick up, or what you call in the lingo, low-hanging fruit. There were assets which were really cheap. So we were really lucky to be there at the time, and we didn't have any losses ourselves, because people who sell those assets were clearly nursing big losses. So when you have a flat book and you don't have any losses, you come and someone comes. It's like the equivalent of someone coming to sell a flat, in Regent's Park for like 50% of its value. You say, of course, I'll have it. But people needed the cash and needed to take their losses. So 2009, not only for me but for the entire industry, was a really good year because you could pick up very cheap asset from distressed seller, and that was my best year ever, actually. On the back of that.
Last question. Any other question? No question. Thank you so much, Salomon. That was very interesting.
Thank
it was
you.
fascinating. You're not just an amazing derivatives trader. I call you now the king of derivatives, King Salomon, the king of derivatives, but also very nice insight and from an academic point of view. So good luck in your now career at Cambridge University and other universities and so on. So thank you so much, and we have a
Pleasure.
break. Thank you so much. Thank you.